in VC, you find yourself quite often you can be right on the analysis, but wrong on the outcome. And by all means, there is a bit of luck involved in the job for sure. And you find people that are can be completely wrong on the analysis, but happen to be right on the outcome, because those are such long journeys. To build a company from scratch takes, into a public company takes 5, 7, 10, 12, 14 years. And there's so many things that can happen on the along the way, good and bad, but certainly good, where if you looked rationally at a company or at a product at the beginning, you'd be like, there's just no way. And then, as it turns out, you give it enough time and enough capital and compounding effect and a bit of luck on the way, and then you end up with a company that's amazing that looked like crap at the very beginning. So that's the job. That's the hard part.
Hey, welcome to this edition of the Data Nerd Herd. In this episode, I got to interview Matt Turck. Matt is probably most famous for his data landscape analysis, which he's been publishing every year since 2012. If you've seen the most recent 2021 edition of it, it is absolutely crazy. It's called the Mad Landscape for a reason. So definitely check that out if you haven't seen it. He's also a partner at FirstMark Capital, a leading venture capital firm. He also writes quite a bit on social media, as well as hosts Data Driven NYC, which I think is the largest data meetup in the country or maybe the world. So Matt Turck is up to a lot of stuff. In this episode, we talk a lot about how he invests, which he says is something that he's actually not asked a lot about. So if you're interested in venture investing, this is definitely a great episode for you. We talk about how to evaluate investments, the current investment landscape, as well as spend a substantial time talking about crypto. So I hope you enjoy this episode. I know I learned a lot. Also, if you're watching this as a video, please note that there was a glitch in the recording of this video. I was somehow only able to capture Matt's video, but it has both of our audio. So you basically get an entire video of Matt Turck staring into a screen. But nonetheless, Matt and I both agreed that the content of this interview is worth publishing as both audio and video. So I hope you enjoy it. Thanks a lot. Matt, how's it going?
It's going great. Thanks for having me. I'm excited to do this.
Awesome. Yeah. So today on the Data Nerd Herd, we have Matt Turck, the legendary Matt Turck, which we'll talk more about. So
legendary, mostly in my family.
Okay. That's awesome. For people who don't know who you are, do you want to give a quick intro?
Sure. I am an early stage venture investor. I work at a firm called FirstMark based in New York, which over the years has been a proud investor in companies like Pinterest or Shopify or Discord or Airbnb and a bunch of SaaS unicorn type companies. I'm one of the 5 partners there, and I focus mostly on the world of data. So data infrastructure, machine learning, AI, whether at the infrastructure level or at the application level. And so I invest in the space, I blog about the space, I do industry landscapes annually. And I also run a community called Data Driven NYC, which started as a little meetup 10 years ago now and has become a 20,000 person community.
Wow.
Where every month we interview top CEOs and CTOs and founders and GPs and book authors in the space, and which has been a wonderful source of inspiration and a lot of fun. And then a little bit as a minor, if you want, in my investing focus, I do some crypto, some fintech. So I'm not exclusively a data investor, but I'm particularly passionate about that space for sure.
That's awesome. Yeah, we'll touch on the investing part in just a bit. Kind of stepping back, how did you find yourself in the tech space in the first place?
So, a long time ago, I actually tried very hard not to become an entrepreneur because I grew up in France with a dad who was an entrepreneur, who had started a software company, basically a healthcare software company. And I remember, a childhood where my dad, who was, an amazing dad and very attentive and all the things, basically spent his entire time working from early in the morning to the evening. And I saw the stress of it. And, he did it like back in France in the 70s and 80s, and in a world where there was absolutely zero venture capital. So he actually built a software product company in a complete bootstrapped way.
Wow.
Leveraging services and and basically worrying about the his cash situation all of the time. So like I remember that it just like didn't sound like fun at all to be an entrepreneur, and I tried very hard to just not do that. And then like at some point, I started my career in a completely different field. I was a corporate lawyer for like a couple of years,
Oh, wow.
which was interesting. A lot of people say they hate being lawyers, but I actually didn't mind it. Worked at a big firm on Wall Street called Sullivan and Cromwell, and that was that was fine. But like at some point, the internet revolution was happening, and it was just so exciting, and it felt like the cost of opportunity of not being in tech was just enormous. And that's where the world was going. That's where the energy was, the enthusiasm was, and it was just like too hard to resist. So I ditched my early career in corporate law. I ditched my big salary to basically become an unpaid software entrepreneur, and much to the chagrin of and consternation of my parents, were like, okay, well, you've been doing all of this, like, why doing this now? So that's how I started. So I was a co-founder of an enterprise software company that was focused on enterprise search and knowledge management, like doing a lot of AI stuff, using mostly Bayesian techniques, because that was before the whole revival of deep learning. And did that, for a bunch of years. So I grew the company. It was a venture-backed company, and eventually we were acquired by Oracle.
Oh, wow.
I joined Oracle as part of the acquisition. Spent some time there, working on a few products, including the enterprise search product that was based on the acquisition of our company, and then left to join Bloomberg LP, the financial data company, Michael Bloomberg's company, to help start the venture and incubation activity there. So I sort of switched from the operational side to the venture and incubation side. Was there for a few years, and then I joined FirstMark as a partner almost 9 years ago. So it's been a super interesting career in tech so far, where like I've been on the founder side, I've been on the operational side, and I've been on the sort of venture and investment side for a bit now.
Do you have a preference in which one you like better? The operational side or the venture side?
I remember being a founder and thinking that our VCs who sat on our board basically has the best job in the world, because they would, waltz in every quarter and, ask us about a couple of ratios and give us a couple of like canned bits of advice, and, and criticize some parts and say like, move faster or do this or do that, and then leave. Never to come back until the following quarter. And I remember thinking, wow, that's the best job in the world. But like I also loved being a founder. I think there's something extremely special about willing into existence something that just doesn't exist, and the thousand of problems and challenges that you face every day, and getting a group of people around you energized to build a company. It's an enormous feeling. To me, it's the closest thing to adventure that you can experience in the business world. And that was extremely appealing and continues to be very appealing. Having said that, being a VC is fascinating as well. I mean, you for like all the cliche reasons that everybody talks about, which turn out to be true, which is you get to speak to amazingly interesting, people, founders all the time, and that's extremely intellectually stimulating. At the same time, like all jobs, like VC has all sorts of constraints and difficulties that I'm happy to talk about if that's interesting.
Yeah, let's dig into that because I think, you know, I mean, I run a company too. I'm probably more like your father than I am like a tech founder in the sense where I had to bootstrap a company, but I think the challenges are still there. But, you know, I look at investing too, and I'm curious, like, okay, and I talk to a lot of investors, and it just seems like it does have its own sets of challenges I have no idea about. I mean, what are some of the things that are top of mind, you know, on a daily basis for you?
Yeah, well, it's you know, if nothing else, it's become an extraordinarily competitive industry.
Mm.
You know, which is which is great for excuse me as I cough, which is great for founders. Like we'll see where the market evolves in the next few months, given the, you know, the evolution in the last few weeks. But, you know, at least for the last 10 years, it's been an extraordinary market for founders because there's never been as many VCs, as many firms, and as much money into the ecosystem that's looking for great places to invest. But, you know, seen from the other side of the table as a VC, it's, you know, you're constantly in a situation where, you know, an investment that you would like to make is getting made. Like, you know, probably as we speak, you know, right now during this conversation, there is somebody sending a term sheet to some company that I would have been, you know, interested in. It's just the way it is. And you know, I started in this job when there was much more of a, at least from my perspective, much more like an almost like romantic idea of what a VC to founder relationship should be. And, you know, the way we practice venture capital at FirstMark is very much, hey, we're not going to make too many new investments a year. You know, it's very much that model of making like 2 to 3, and with the lead investors. And you know, most of the time we get on the board of the company, and it's not like because we want to be on the board, it's more like the spirit of it and like the level of commitment. So, you know, there's like very much this idea of this is the beginning of a long journey. We know no company, even like the most successful one, go, you know, straight up and to the right. There's always challenges, but we're going to be working together, you know, hand in hand over a long period of time. So let's get to know each other before making a new investment, and you know, all the things. And that was, you know, when I started in the business. And you know, fast forward to today, especially the last couple of years, I mean, it's like this crazy runaround where everything has become pretty transactional and highly competitive. And, you know, like I sort of joked on Twitter at some point in the last few months that the first board meeting is a new due diligence. So it's a little bit, you know, it used to be ready, aim, fire. Then it became ready, fire, aim. And now like we're in the world of like fire, ready, aim, where, you know, so you see a lot of people like jumping into this 10-year relationship based on, you know, a phone call. And you know, I think that's challenging. That's challenging because like if you don't do it, like you miss out on a bunch of really interesting deals. And that's challenging because if you do it, then you know, you start again this very ultimately this very intimate relationship that you have with a founder or a group of founders over a long period of time, like without knowing each other. It's just like a shotgun marriage, like again and again. So, you know, look, I'm very aware of it. So like I try not to do it, and I try to spend time with people way before they raise, when they let me. You know, it doesn't always happen, to like get a sense if there's going to be a fit or not. But that's become the reality of the market, right? So very transactional, very fast paced, highly competitive, and I think the nature of the job has changed quite a bit.
Interesting. I mean, how much of that do you think stays the same though, in terms of having to, I guess at some point, deal with the quality of the founders and the team that you invested in? Like it seems like in a hyper competitive environment, like the quality and the characteristics of a good person and a good relationship probably don't go away, but maybe figuring that out before or after the fact becomes harder. How do you filter for that?
Yeah, that's exactly right. That's a big part. So what you can filter for is, the quality of people on paper, and you can do some back channeling. So certainly there's a category of people, and that is a problem, right? But there is a category of people that will fall in the category of people that every VC wants to invest in, and like typically those people have gone to certain schools, like those people have worked at certain companies. If you've worked at like Stripe and the Airbnb and like that type of company, and you did like worked on some engineering project there, and like you're taking this engineering project to turn it into a company, you'll have a million VCs just like jump on you, right? And part of the reason is that one, that has proven to work, most importantly, and second, because like you sort of know, like you have a sense for the caliber of people, right? Because on the whole, like companies like Stripe and Airbnb or whoever have access to the best candidates, therefore they can afford to be super selective, therefore the people that are there tend to be good. On the whole, there's plenty of exceptions to this, by the way, as you would expect, but like it's not as obvious to everybody as it probably should be. And so like that group of people is like easily referenceable and all the things, right? And you could argue that it's a problem for the system, because that's partly the reason why, if you don't fall in this like immediately obvious category, and particularly if you're a minority, whether racial minority, ethnic minority, gender minority, all the things, you often you're not going to fall in those like easy categories, and and like in a context where like people have their biases and like everybody's running around like looking for deals like that is very easy to overlook those groups. So the system is not perfect. I happen to be optimistic about it. I think directionally it's been very good, with like some obvious issues that need to be fixed. And I just mentioned like underrepresentation of certain categories. Although I'm optimistic there, I think that's evolving as well. But I think directionally venture capital has proven to be very effective in terms of like supportive innovation. I think the daily reality of like how it's done and how rational certain decisions are or not, can be is often not what it should be. But like directionally as a system, it seems to be working, I think.
In a hyper-competitive environment like this, how often do you think groupthink or sort of like lemming-like behavior comes into play when investors are chasing deals?
Yeah, so look, I think there's certainly a part of that at play. Mm-hmm. At the same time, I've grown to, with experience, to at least understand why that happens. Mm. And, the easy way of understanding this is like, oh, people have like no originality. They're just like, glorified bankers that push money in one way or another. I think it's like a little more nuanced than this. I think there's a couple of realities here. One reality is that the fact that this herd mentality happens actually can be very good for you as an investor, meaning that if you invest in the right categories as an early stage investor, it's more likely that others are going to be interested in the company and come in the later round. And if you do a Series A, the Series B, you'll have a group of people that will be interested in this, and therefore it's more likely that the company will be able to raise next round, and therefore it's more likely that the company is going to be able to succeed, because almost by definition, if the company doesn't raise the next round, for the type of companies that we invest in, which are almost by definition unprofitable, those companies will just like go away, right? So you can be the whole like contrarian and right is like what like every VC believes that they wants to believe that it's what they do. The reality is like being contrarian and wrong and being in a category that no other VCs has any interest in. It can be extremely painful, and your company that like you really really believe is going to change the world, like if no other VC comes in for the next round, like it's effectively dead in the water, right? So there's a little bit of that phenomenon. So it's not completely, you could argue whether that's good investing or not, but it's not completely irrational in that it's more likely that your company is going to be able to keep going if you are placing yourself from an investing focus perspective in a category where that herd mentality is more likely to happen, right? So that's one thing. And then the second thing, perhaps more encouragingly, is that I think VCs, like on the whole, you can make fun of the category, and I certainly do on Twitter all the time.
Oh, I see it all the time. It's funny.
Yeah. No, but look, I think there's plenty to laugh about, and I think it's like fun and enjoyable, and I like the banter online and all the things. But at the same time, directionally again as well, I think VCs are pretty smart as a category. It's just like attracts a group of people that on the whole are pretty smart. And I think what happens is like everybody's is like understands how venture capital works, which is you're looking not for good companies, you're looking for exceptionally great companies, because that's how the venture economics work. That like the way you return funds multiple times if you find like crazy outliers that succeed massively. So that's the way it works. So like everybody's looking for this. Everybody understands that like on the whole that tends to happen. You tend to find those companies around specific inflection points. You could argue that for the last few months, there's been like a big inflection point in Web3 and crypto. I mean, there was one, earlier, but that didn't pan out. There's a new inflection point now. You could argue that, the topics that like you and I like to talk about, like data infrastructure, there was an inflection point around the time, Snowflake really started accelerating. So like there are moments in time, and sometimes it's a new market, sometimes it's a new channel that opens. So when Facebook really accelerated, there was like a whole set of opportunity that appeared for consumer companies that realized that they could reach a bunch of potential customers through Facebook, right? And that lasted about 2 years before the customer acquisition cost increased dramatically. Like you could argue that maybe like some of this is happening, I don't know, through Web3 or through TikTok or whatever. But bottom line is that every VC is looking for those inflection points, and because people on the whole are pretty smart, they understand that an inflection point is happening, and what's happening, well, everybody's like is going for the company that are going to be benefiting from the inflection point. So I think that's largely what happens. Ultimately, the ideal scenario, as I mentioned earlier, is a famous contrarian and right. Like if you navigate like all the way away from the flock and you find a company that's different from all of this, but typically, and that company succeeds massively. That's how you get like the crazy returns in venture. But typically, what that means is that company was actually early to that inflection point, right? Nobody understood that an inflection point was coming, and that company happened to be placed right perfectly for that inflection point. Was not too early to market, which is like the most painful thing. Was pretty close to the inflection point and caught the wave as it was forming.
Yeah, that's interesting. I mean, I guess in the data space, which is the space that you and I operate in, what are some early signals that an inflection point is underway? I mean, as an early stage investor, I would guess that you need to be sort of hyper tuned to things that are happening in the market probably before late stage investors are. Are there certain signals that you look at?
Yeah. Look, there's been like, this. Let's take a few examples. There's been like some interesting ones. I mean, certainly. If you look back 2012, the ImageNet competition, where it turned out that group that was led by Jeff Hinton, trounced like all previous performance at ImageNet using deep learning, because it had turned out that if you fed a ton of data to deep learning, those pretty old algorithms, at the time actually worked amazingly. Like if you sort of followed the circles, that was a very big deal. I heard about it because I'd been like in the data and AI space for a while, and like people got like really excited about it. And there's always like a little bit of a ripple effect where like nothing happens immediately, but like sort of by 2013, 2014. a lot of smart entrepreneurs that started saying, well, actually, this deep learning thing is going to be a big deal. And there's companies that are going to be built on that, that are going to be completely category defining or category dominating. So that's an example. Another example is what I alluded to earlier, the rise of data warehouses. And like sometimes it takes a while, right? Like, Redshift had been around for a long time ish. But then Snowflake had like this crazy rise. And I think when people started realizing the kind of just crazy momentum Snowflake had, people, entrepreneurs, it's always, by the way, it's always founders that are, and scientists that are getting the way, right? Like VCs largely just follow. We look for the inflection point, but, by all means, like we don't create them and we can accelerate them to some extent, but we don't create them. And I don't think we're particularly good at predicting them, but like we hopefully good at like spotting them. But when people realized the crazy momentum of Snowflake, it became pretty clear that there were going to be a bunch of companies that were going to benefit from this energy, right? And there were like companies that were, on the left side of the warehouse, like the, 5 trends of the world, and that whole category. And then, on the right side of the data warehouse, like all sorts of applications. And like we've seen, particularly over the last couple of years, like all sorts of categories appearing, like reverse ETL and like metric stores and all the things. So that was, because the rise of data warehouse was such a big sort of unlock in the system. From a VC perspective, you're like, oh my God, that sort of changes all the things, and you look for companies doing interesting things in those spaces.
That's interesting. Yeah, I mean, it's hard. Sometimes I think it's hard to spot when you're in the middle of it, even as a practitioner. Like I remember, who was it? Taylor from Fivetran, he's a COO. He emailed me back, it must have been 2016 or something, and he's like, "Hey, do you want to move data from Postgres to Redshift?" Because I was using Redshift at the time with our new tool Fivetran. It was like $100 a month. I was like, "This is like the dumbest thing I've ever heard of." No. And then upon reflecting on that, a few days later, it's like, yeah, actually, this is interesting. Because I didn't understand. Because I came from a background where ETL was what you had to do, right? And so what he was proposing something entirely different. And I think just being in the weeds so often, it was you kind of stuck with your own religion, so to speak, and it didn't. It took kind of an outside nudge to figure out, okay, like this was actually something. There's something here.
Yeah, no, for sure. I mean, that's we're talking about the challenges of VC. It's one of the many nuances. You go, like, you see something new appearing, and then if you're if you're a VC and you do your job professionally enough, like you're going to go to your network, like our friends and colleagues, and you're going to say, well, like, is this interesting? And pretty often you're gonna have, like, people are gonna say, no, like, first of all, that's never gonna work, and 2, that's kind of stupid, and 3, whatever, like, my team does this with a spreadsheet, and that, it's just fine, and like, there's no way I'm gonna pay like $100 a month to do this, or $10,000 a month to do this, right? And like, that happens fairly often. So the feedback that you get from people that are very smart people, it can be negative. And, there's been a number of examples, especially early in my career as a VC, where I'm like, okay, well, I talked to everybody said it was stupid. And actually it turned out, like, 3-4 years later, all the people that I talked to, like, used the product in question. Right. And again, like, it's just great people, smart people, all the things. It was just like, at the time, it was a combination of, like, it was not obvious, to the product that they looked at was just not great, so the classic thing in VC is that, like, you never invest in companies for what they are, you invest in companies for what they can become. And what you look for is companies that, if it works, is going to work, massively, and it's going to be like an incredible company, and like a movement almost, right? So that's one of the nuances. So in VC, you find yourself quite often you can be right on the analysis, but wrong on the outcome. and by all means, there is a bit of luck involved in the job for sure. And you find people that are can be completely wrong on the analysis, but happen to be right on the outcome, because those are such long journeys. To build a company from scratch takes, into a public company takes 5, 7, 10, 12, 14 years. And there's so many things that can happen on the along the way, good and bad, but certainly good, where if you looked rationally at a company or at a product at the beginning, you'd be like, there's just no way. And then, as it turns out, you give it enough time and enough capital and compounding effect and a bit of luck on the way, and then you end up with a company that's amazing that looked like crap at the very beginning. So that's the job. That's the hard part.
What's an example of a company where you felt like this? There's no way this is going to work, and then they just surprised you?
You could argue the entire Web3 excuse me, Web3 blockchain space. At FirstMark, we started looking at that space very much to the credit of one of my partners or former partners, not me. But we started looking at the space in 2011. Mm-hmm. Even before I showed up at FirstMark, people had done a Bitcoin day where that invited whatever startup in the space were around at the time to come to FirstMark and pitch and all the thing. And and thankfully we made some great investment in the space, but there's a number of companies where I looked at it and I was like, this is made up. This is none of this is real. None of this is you'd find yourself in pitch meetings where you'd be talking about some arcane sort of derivative of that problem that was related to that other thing. And it was a very intellectually interesting conversation. But you took a step back and it's none of this is real. This is made up. We could you actually probably made up that thing during the meeting, and that was that for what, and arguably still in the crypto and Web3 space, when you have this conversation, a lot of it is kind of made up, but sometimes that's what innovation looks like. And there's a system of belief and then a quality of people, and again with time and capital and a bit of luck, those things go from just made up stuff to being very real and very impressive.
That's such a good point. I've had so many false starts in my opinions on tech over the years. I kind of grew up on the internet starting was it 92? I got my first email account. I think it was just a kid, but so it's around before the browser and stuff. And so I got to see all these, inflection points and changes in tech. And I think the thing that always held me back was just saying, oh yeah, that's a stupid idea. And I think the suspension of disbelief is a really healthy thing when it comes to stuff like Web3, for example, just because I don't know where it goes. I don't think none of us knows where it totally goes, but there's something there, right? Yeah. And
but what's hard is that there's a lot of head fakes as well, right? Yeah. In when was it, 2015, 2016, we were all super convinced, for example, that VR, AR and VR was literally around the corner, and that completely fizzled out, right? And hopefully it was the whole metaverse thing and some stuff happening on the hardware side. It's coming back, but as an investor, but also as a somebody who's very passionate about tech, I was super bummed. I was like, oh my god, this was so cool, and then that just completely died, at least for a bit, right? Consumer 3D printing. Mm-hmm. At some point, everybody wanted to make a bot on their
it's 2010, 2011 or something.
Yeah. That was a huge thing. Same thing. I was super excited about it, and then so sometimes innovation is here to stay, sometimes it's not. Nobody can predict. But that's where I'm saying, directionally, I think the venture capital and startup world is sort of working, right? Because as a system, it's 1,000 experiments that are happening at any point in time, and individually, it's very possible that many of those experiments either fail or are not optimal in terms of the relationship between VCs and startups. But as a system, it tends to work very well, I think.
Have you put much thought into, I guess, the combination of Web3 and data?
Oh yeah. I'm actually super interested in that space. Maybe 3 years ago, I did a presentation on the intersection of AI and blockchain. That's still somewhere on my blog, I think. And talk about like stuff that was made up. Like, there's like a bunch of things.
It almost sounds like a meme.
Yeah, exactly. And it was, and then there were like some people in some projects that were like dead serious about it, like basically looked like, some of it looked like it was basically some kind of like, fraud or scam or like of some sort, and perhaps some of it was, but conceptually the intersection of it is super interesting. And there's many ways this can happen, but like the general idea of sort of pooling resources around AI is really interesting, and crowdsourcing is very interesting, and that's decentralization is a wonderful platform for it. So actually, just couple of days ago at my Data Driven NYC event, had Richard Craib, who's the founder and CEO of Numerai, which is an AI-powered crowdsourced hedge fund, where basically they provide data to the community around the world, and then everybody can participate into the system, where they basically provide a model based on the data to help predict the stock market. And there is a crypto component to it. There is a token called Numeraire that you stake, and the more confident you are about your model, the more money you stake. And Numerai puts together those various models. And as it turns out, Numerai has had a very impressive performance compared to quant hedge funds in the last couple of years, which, admittedly is impressive, but also not impressive, because, I think all but 3 hedge funds last year beat the S&P 500.
Right.
But leaving that aside, the Numerai, which I'm not an investor in, I just think it's a very cool project, is a great example of this intersection of AI and crypto. And if you think of crypto and blockchain, I mean, blockchains fundamentally are databases of some sort, right? Like they're a different type of database, where instead of rows and columns, you have a series of blocks which get validated. Ultimately, we're talking about core data infrastructure, right? So I think I think crypto is here to stay. I think we're way past the point of no return, critical mass, all those things. So there's a world where that blockchain type architecture is going to become a core database, and like, for now it's easy to make fun of them because they're bad databases, like all the things. But again, like with time and capital and enough entrepreneurial energy, most importantly, the things that don't look very impressive can end up looking super impressive. Mm-hmm. So I think that's going to be a core component of the data world. Yes.
Yeah, I think so too. And one thing, the decentralization thing, I think I've been thinking a lot about that as well. I mean, I just noticed, like, there's a lot of latent computing power just on devices everywhere. Why aren't we taking advantage of this in some sort of decentralized way? I know that there's projects working on that, right? But it's just that you start, just a lot of obvious things where this could work. Why do I have to use a cloud? Why can't I just use?
No, all the things. I mean, not to be the VC plugging in a portfolio company, but that happened to be a particularly interesting one. I was a very early investor, actually, the first check into a company called Helium, which is a decentralized wireless network that basically enables you to provide connectivity to any connected device, and soon any 5G phone. that's a perfect use case for token economics.
Right.
Interestingly, the company when it started, which was back in 2014, wanted to build exactly that, like this decentralized wireless network where, instead of going to AT&T and paying, $2 per device per month to plug in your connected, cup of coffee, which makes no sense economically. They wanted to provide this very, cheap and ubiquitous connectivity network, wireless network. But like at the time, the question was, why would people participate into that network? And token economics were exactly the answer for this. And the way it works for Helium right now is that anybody, and including me, for example, like I've bought several of those hotspots, which are like bits of hardware that you plug into your connectivity source, and where you become a node in the network. And as you provide connectivity to the network, you get rewarded by tokens, which are HNT tokens. And and then you've effectively solved the supply side of your network. And this thing is going gangbusters. And, I don't know when that was, maybe 2 years ago, we had like 0. And now there's like 500,000 in the network, which is just completely crazy. And like for the first time, there's going to be there is a decentralized network that was built for a fraction of a fraction of a fraction of the capital cost that all the AT&Ts and Sprints and T-Mobile of the world had to incur to build comparable networks. It's just fascinating, right? There's like massive sort of like crowdsourcing exercise at scale. Helium, again, like not to push the portfolio company too much, but I think that's one of the most fascinating projects out there. Like the more like sort of pure expression of like the quintessential rationale for decentralization.
That's really cool. I'm gonna check that out actually. So start it out. I guess what are some other areas? I mean, it seems like when we talk about decentralization in Web3, we're talking about maybe unseating gatekeepers, for lack of a better way of putting it. What do you see as some of the obvious targets for Web3?
I think, there's certainly an element of Web3, which is cultural and community. And there's a little bit of, fight the power type aspect to it, which which is, interesting. And like, it's a cool, different like ethos that I think has a lot of people like rallying around it. So whether that's foreign governments like Venezuela and all the things that people were talking about a few years ago, or whether that's the power of the Googles and the Facebook / Meta, that's certainly an element. Like the way I view it personally is a bit different. I mean, I think it's very important to have like counterbalances in any society, and I certainly see why that's important and valuable and that type of thing. I personally, what gets me excited is more the one, it can be extremely efficient at scale. So that's the example of a Helium. Why spend like billions and billions if you can do something that's going to be faster and cheaper. And then there's an element of more importantly perhaps of like everybody getting a chance to participate in those networks. This kind of like democratization of participation and democratization of rewards, which I think is just really fair. So like the whole NFT thing, the fact that if you're an artist, you can set up your NFT in a way that you will benefit from the resales going forward of whatever art you produced, feels feels really really interesting and very fair to me. So I as a society and as an economic system, it feels very interesting.
Yeah, it reminds me of the early days of the web. I think there was a lot of promise back then. It reminds me a ton of that actually. That I think and hopefully this time we can get it right. I think that what screwed up the web early on was there's just a lot of money in it, frankly. So everyone wants to get in and get their slice of the pie, right? So
look, I somebody very smart, I don't know who said, there's no major technology progress with that exuberance in the beginning. Like I forget the exact quote, but like it's, we're certainly in those phases. And look, I mean, there's plenty of obvious issues currently. There's plenty of people that are in it for the wrong reasons. There's plenty of speculation, like all the things, right? But in some ways, that may or may not matter. And the excellent thing is that it attracts a lot of smart people with a lot of ambition and energy to the space. And at some point, it becomes a little bit of a self-fulfilling prophecy where the smartest, most ambitious people working on something very passionately end up creating something that exceeds anybody's expectation.
How do you think Web3 might impact VC as an industry?
Yeah. So let's see. There is a pretty trendy line of thinking, which is to say that effectively it's going to displace VC entirely. And there's a couple of different avenues for that. Like one avenue is that like all crypto projects are going to be financed through tokens, in a crowdsourced way, and there's going to be like different type of people that are just going to be joining the project. Why would you need a VC when you can just like ask a bunch of different people to back your projects? So that's one thing. And like another one is to say, well, the concept of DAOs, like the decentralized autonomous organization, well, that's what the VCs of the future are going to look like. Instead of wanting instead of VC firms raising money from LPs, like everybody will put money in a DAO, and the DAO collectively will decide to make the investment or not. I think there's some merit to all of those, and I don't want to discard. I don't want to discard any of those ideas up front. At the same time, what I'm seeing is that the entrepreneurs and founders in the space are actually, on the whole, very interested in having VCs on board. And typically more than one VC. There's the current structure seems to be, for every round, a Web3 crypto native VC, and then more of a traditional VC firm that happens to have interest in the space. You see a lot of rounds being split, and then like a bunch of angels. And I think that corresponds to a pragmatic reality, which is that, again, it's a long journey, and, you want people that are going to be around for a long time, and those tend to be professional people. If you get like a bunch of people to, put small amounts of money where like nobody really has skin in the game in your project, that'll be cool. That'll solve the immediate problem. But it's again, a long journey with some ups and downs, and especially during the downs, you want people that will be around. And sometimes people will make decisions that are not entirely rational, which is to like continue supporting the project in one way or another. Where like most individuals, because they don't have a lot of skin in the game, would say, screw it, like, okay, that was cool, that didn't work out. And that, like, VCs are in the business of doing that. So I think the VC model is certainly evolving. I think like those rounds for crypto companies are certainly shaped differently. They will continue to evolve. But I don't know. Maybe I'm part of the like group of dinosaurs that doesn't see the asteroid about to smash them. But I think there's something about human nature that makes it so that you need a group of people to build something. You need a core group of people, and the finance and support part of that core group seems very important to me, and not going away anytime soon.
I would agree with that. We have several clients at Ternary that were crypto companies, NFT companies, and so forth. I think the common thread is they work on crypto projects, but they're still using VC money, VC advice, consulting companies like mine to help them get off the ground, and cloud computing technologies from one of the big three clouds. So everything except for the business objective is very centralized and very old school. So, because what you described with the DAOs right now, that sounds more like GoFundMe than it does like a viable investing model. It could work. But
no, look, I think what everybody says, like the pragmatic and sort of down to earth people that I speak to in the space, like everybody like acknowledges that reality and just says, well, that's what you need, the steps you need to go through to get to the eventual goal, and it's going to be progressive decentralization. But yeah, like as of now, it's almost funny, right? Like even like from a geography standpoint, right? It's like everybody's congregating in New York these days. I mean, a little bit in Miami, a little bit in other places for sure, but like New York has seen like a massive influx of people that are very passionate about like Web3 and crypto.
Interesting.
And it is sort of funny, right? Because like by definition it's decentralized, so it should be like all over the place. But ultimately we're still we human beings, and like we like being together, and like pandemic nonetheless. There's something very special about like you grab a drink at a bar with like some friends, and you like chat about like your NFT project or your DAO or whatever. That's like how things are are done ultimately, like with social animals. So even that is like a geographic centralization of the decentralized universe. And I mean I'm obviously caricaturing a bit, but that's interesting. And if you look at the most successful crypto companies right now, they're all ultimately centralized companies. Like Coinbase is a completely centralized company. Like a bunch of those successful exchanges are centralized companies. What have you? OpenSea is a company in Soho, New York. DCG Digital Currency Group in the FirstMark portfolio is based in Stanford. So it's a very centralized industry that's largely financed by VCs as of now. That's just the reality of it. Doesn't mean that it will not evolve. And I think decentralization as a goal is a really interesting prospect.
Kind of switching gears and speaking of things that are, I don't know how to put this and tie it together. Massive, somewhat centralized, somewhat not. Let's talk about the MAD index real quick. Yes. Yeah, something that's equally as crazy as crypto. So, I mean, you publish this MAD index every year. I've been looking at it for a long time. I think when I first saw it in the early 2010s or something, I was like, this is kind of incomprehensible. There's a lot here. Fast forward to today, and I can't even read the thing. I need like a magnifying glass or the James Webb telescope to actually make sense of it. So, where do you see the data space going? I mean, there's a lot going on right now. I personally can't see this the number of companies exploding into infinity like this. That's indeed the question, especially like we're on the tail end of a crazy couple of years. We were talking about inflection points earlier and Snowflake and all those things. I think that has resulted in a whole range of new investments and acceleration of excitement of VCs and founders, most importantly, in the data infrastructure space. So like as we were saying, there's a bunch of new categories that appear, like reverse ETL and metric stores and then like what have you, and then the sort of because that was an unlock and because that solved this very core problem of the data space, which is like to store data. That unlocked like all sorts of activity around things like machine learning and AI, that like, okay, well, now that you have like your core need at the bottom of the hierarchy of data needs that's addressed, you can focus on like another part. So between the opportunities that were created like in and out and around the data warehouse, plus other spaces that were somewhat related to the data warehouse, but that became hot just because like people were no longer worried about the storage. All of this like created like this crazy wave of excitement, and there's been this like massive amount of new company formation, VC investment, like even within those firms, like a bunch of like
VC partners that like I never really thought about the data space. Suddenly, like people are like, oh, I'm a leader in the data, thought leader in the data space. So which is a perfectly fair,
yeah,
and fine, but like vaguely amusing. So I think we sort of on the tail end of that period.
mm-hmm.
I think there's a bunch of categories that went from non-existent to nascent to overcrowded in just a couple of years, and within those categories, there's a bunch of companies that have very smart founders, great product, or early but encouraging products, and great VCs behind them, but everybody's more or less at the same stage. So some companies have raised more or less money, but like from a business standpoint and like a revenue number perspective and a number of customer perspective, they're all more or less at the same space. And what's going to happen within those categories is sort of an open question. And even if they win those categories, like, so if you look at the Mad landscape, there's all these little boxes. Even if they win their little box, so the question is, okay, what are the immediate adjacencies around those boxes, and can they win that? Knowing that the companies in those boxes will also want to win their category, right? So like at some point, the whole thing becomes hyper competitive. There's too many companies going after the same problem. So that's the sort of bearish way of looking at it, and we can talk about whether that results in failure or consolidation or winner take all. Like that's certainly one discussion. The other way of looking at it, though, is to say, all right, if you truly believe that every company is going to become a data company, the way every company is becoming a software company. And if you compare the data stack to the software stack, you can make the argument that actually the data world is vastly under-tooled. And that there's like a bunch of different, products and part of the ecosystem that are missing, and like everything is early, and some of it is starting to be scaling and doing great, but like most of it is still like early, and maybe there's room for like new categories and new tools and like better systems and that type of thing. So maybe there's a world where we collectively sort of bearish for the immediate next couple of years, but bullish long term. Because I certainly think that market as a whole is going to continue growing massively.
I agree. Yeah, it feels like we're just getting started in the data space. I mean, I've been in the data space for a very long time now, and it's interesting. I think the technologies are improving. We're able to do things we weren't able to do before. Some of the same problems remain. I think the biggest one is just, do I trust the data or not? That doesn't seem to go away anytime soon. But then, other problems, I say the technical problems are getting easier for sure. The other day, actually, a friend of mine, Devaris Brown from Araxa, he texted me a video of creating a data pipeline in JavaScript, which I was like, that's pretty cool. So what if we just move everything up to the application layer and just kind of reverse the data stack? Actually, maybe that's an idea. I don't know. So,
yeah. No, look, there's a whole vein of opportunities around, simplification, abstracting away problems, no code, low code, enabling analysts or even business people to do things that only data engineers used to be able to do. For sure, there's plenty to do there, plenty of opportunities. It continues to be super complex, including some of the most prominent companies in the space that are, notoriously complex to use, as far as their products.
I guess one kind of thing that we didn't touch on, but we sort of alluded to at the beginning, is there's inflection points, and I'd like to get your take on this with Federal Reserve about to raise rates. We've been, telegraphing this very clearly. What do you think this does to valuations of tech startups?
Yeah, so that's literally the billion or multi-billion
trillion
dollar carton. Trillion. So look, with the obvious caveat that I don't have a crystal ball, I think the way I think about it is if the stock market correction continues to happen, and if you look at Nasdaq, which is very tech stock heavy. I mean, we certainly way into like correction territory, and this week in particular wasn't great, but it's been going on for months now, right? So there's something that feels more sort of structural.
Mm-hmm.
And if you if you look at that, and if you look at the various tech IPOs of perfectly great companies that are all pretty much in the red, like the recent tech IPOs, not all of them, but most of them. It's hard to imagine that that's not going to trickle down pretty soon to private markets. So whether that's a month or 4 months or 5 months or 6 months, I don't know. But that historically there's been a little bit of a lag, but that happens sooner or later. So that's one thing. The other thing that one can think about is like, okay, like there's been a bunch of VC firms that have raised tremendous amounts of money. What happens to all that dry powder? And isn't that a situation where that money is going to have to go somewhere, and as a result, private company valuations are going to continue remaining high. So there, this it could go in different ways, but there's one doomsday scenario where the market actually just completely tanks, and like Russia invades Ukraine, China invades Taiwan, and the whole world goes to shit. then what happens to that dry powder is that it never gets deployed because the LPs basically call the money back, or something happens like structurally. So that's one doomsday scenario. There's another scenario where the market continues to go down and like none of those terrible things happen, where actually a lot of that money goes to existing portfolio companies. So instead of chasing the next shiny objects, we're collectively in a situation where startups cannot find external leads, and therefore all the VC firms and possibly crossover funds find themselves in a situation where they need to support the companies in their portfolio with internal rounds. In that case, all the dry powder goes to those companies. So that's another scenario. And this, look at that, like, who knows? That's absolutely a scenario where what's happening right now, and I would love for that scenario I'm about to go through to be the actual reality. But there's absolutely a world where like all of this is a little bit of a head fake, a little bit like a soft landing, and ultimately very healthy, where, for a period of, 1 to 6 or 9 months, like the market goes down, like tech, comes back to much more rational, multiples. And then, like at some point it feels like the system got healthy again, and because the underlying economy is doing well, and like none of those terrible things happens, and then like things go back up again. So that's that would be the sort of like soft landing, market auto correction, where actually it could possibly be the best thing that could happen to us collectively, even if it's scary during the first bit. So we'll see.
Who knows? Yeah, I'll give you more time to make friends with founders and stuff. So
yes, well, yeah. I mean, certainly if there was a prolonged correction, I think that would change a lot of things in the VC ecosystem. I'm pretty sure we would go back to a version of the past. And there's a lot of money coming from lots of like non-traditional venture sources, and first-time funds, and like solo GPs and other thing. I think collectively it's all great, and it's been I think really good for founders and all the things. So like not criticizing it. At the same time, in a bear market, historically those recent entrants and recent arrivals tend to go away. Sooner or later, it doesn't happen immediately because it's not a immediately responsive market, but like that tends to happen on the whole. So it was like in prior bear markets, it was like corporate VCs, like there's like a bunch of like every company had a corporate VC arm, and then the minute the market corrected, like all of this went away. I think crossover funds is an interesting question, because it's very nuanced, because there's all sort of different type of crossover funds. Like some of them, actually, including Tiger very much, which is the most famous of them, has a long history actually of private investment, in venture. Like they were like early in China tech, early in India tech, where like in a bunch of great US companies before they started like this crazy overdrive that they've been doing for the last couple of years. So there's nuances that different funds reacting differently, but ultimately crossover funds are funds that cross over, right, between like private and public markets. And absolutely, if the opportunity in private market ceased to be exciting, and there was more money to be made in private market, they would cross over to the back to the other side, and that's what they do. And they like smart and savvy investors, and the whole model is to be able to move around to where the action is and the returns are. The question is where that leaves us in the venture world, and if that money goes away, because look, everybody, like many great companies have a chunk of their cap table now that belongs to those crossover funds. Like what happens if the market goes down and those crossover funds leave the scene? That's an open question. So I do think that if the market was to be in bear territory for a long time, which we don't know yet, and again, I hope it won't, but like if it was, I think that would move the venture world back to a version of what it was before, for sure. Because VCs, that's what we do, right? That's the one job, that's the one asset class, and even if you didn't want to, like we have to stick around like with the companies that we invested in. That's the model.
Yeah, I know as somebody who runs a bit. I mean, I definitely have a list of data products that I've wanted to build, and but right now I'm just like I don't know. It's so competitive to start a company, and like, what advantage would I have at this point, unless I had some unique insights, and so forth. But to go into to come up with like another data observability product, right? Like I wouldn't dare go into that space right now.
I would not do that. Yes.
No, no. But other listeners, if you want to do that, go for it.
No, look, I mean, we're bantering a bit, but like I think data observability in particular is it's a fascinating category. I think it's an obvious category where you're going to see one, but hopefully more great companies. Like everybody trying to be the Datadog of data, right? Which is always a funny comparison, because Datadog has the world data in it, but like Datadog being a fantastic company focused on a different part of the world, which is DevOps.
Or the dog of Datadog, whichever.
Yes, exactly. So, if it's exactly the conversation we were having a second ago. Like if you look at the various subcategories of data ops, like everything is crowded, right? Whether that's data quality, data lineage, arguably like catalogs and governance, and depending on what you include in data ops, like and data observability as a concept, trying to like merge data lineage and data quality. And even within data quality, you got like different camps, right? Like you got the superconductive / great expedition of the world doing like effectively declarative data quality, and then you got the anomalous of the world doing AI based data quality, and like obviously both of them ultimately probably merging towards like doing everything. But there's so many companies, and like some of those companies like Monte Carlo got like crazy funded, right? And I everybody acknowledges that those are great founders and all those things, but effectively raised like 3 rounds of funding like back to back, and then there's like Big Eye that raised a bunch of money, and then like there's like just like so many other companies, right? So I've met and I know a lot of those founders, and like they're all like super impressive, smart people. And as a big fan of the space, like I want like all those people to
Yeah,
succeed.
same.
But like I wonder what that's going to look like specifically within data
Well,
observability.
especially as you say, like, these companies have to compete in adjacent territories at some point. Once you
Yeah.
dominate your category, well, let's go out for some other people. So,
That's right. Like, right,
right.
because to be the data dog of data, you like if you look at Datadog, I mean Datadog as a range of like, I mean they cover like I forget the number, but like 8 categories, right? Like and a lot of it through organic product build, some of it through acquisition, but they keep expanding like the range, and that's what success looks like
Yeah.
in this category. So if you translate that to data infrastructure, to be that big, you're going to need to do all the things, right?
All the things. Cool. Kind of switching gears a bit and kind of wrapping up. What do you like outside of work? I mean, I see you a lot on social media. See a lot of your articles. We talk once in a while, but what makes you tick?
Yeah, so I do spend a fair amount of time just working in general. Like not to sound too cliched and all the thing, but like I'm super passionate about that space, like data, AI. I'm also very interested in Web3 crypto, like some of the stuff we talked about. I do love the craft of venture capital, even though there's some frustrations that we talked about. So like I think it's I find myself working and learning about the space almost as a hobby, which is like a
Cool.
crazy privilege, right? Like when the stuff that you read about or that you want to learn more about as a hobby happens to be your day job, that's how you're sort of doing what you meant to do, one of the things you meant to do from a professional standpoint. So I'm very privileged from that perspective. Having said that, obviously outside I got tons of different interests. First and foremost, I have a family, I have a wife and 2 kids, and that certainly is the most important thing I do outside of work. And then with a little bit of time that's left, like all VCs, I kite surf. So I grew up windsurfing and then switched to kite surfing, which is just absolutely fantastic sport, and that I would recommend to everyone. And then I see behind you have keyboards. I also play the piano.
Nice.
For like pretty much all my life, although pretty badly, but that's something that like I do certainly do for fun. And then like I do all of this is a little bit of a marathon, like for all of us. So I certainly work out and try to stay healthy. And then I discovered during the pandemic, I discovered the joys of the kettlebell.
Nice.
Which I tried before, but I hadn't quite realized that like that thing is basically a gym all in one, and
It's a gym all in one.
Yeah, when we're like confined, and like I worked in my Manhattan apartment. I got a kettlebell, which by the way was really hard to get on eBay. Like,
it was impossible at one point.
It was impossible, right? And I discovered that, and that's proven to be just absolutely remarkable as a workout. If you do it like in a HIIT kind of way. Like in at least me, like in 25 minutes I'm done, and that's super efficient. So like I discovered that, and then
do you keep one at your desk?
No, but I have 4 at home now.
Nice.
A little bit to my wife's chagrin. But I think that looks cool. Like at some point during Zoom calls, like you could see the kettlebell a little bit, on the side. Like so, like I was like, I hate to brag, but I kind of like work out, like I'm that kind of dude.
Do you have like a 235s and like 253s or something, or
no? I have a 30. I have 220s, 135, and 145.
Nice, cool.
And the reality is that 35 is great for most of what I do.
I think that's like the perfect weight. If you get 2 of them, you can do like squats or whatever. And
yeah, so it sounds like you're a fan.
I do like a lot of CrossFitting and stuff. So
okay.
Yeah, but if you take your kettlebells down, if you like do farmer carries down the sidewalk, you can look really dumb and get a good workout. So just take them and just walk down the street. That's it. That's your workout.
Yeah, I'll try that. But that was that was I mean, I've been recommending that actually to folks around me because just like spending like 2 hours at the gym is just like not fun and not productive. And that thing, it's like the perfect combination between a cardio workout and a weight workout. And just like find it absolutely fantastic.
That's cool. Well, Matt, it's been good talking to you. Glad we got to finally connect. So
absolutely, really enjoyed it, and just congratulations on everything you've built, and you know, this podcast, and it's like really enjoyable.
Cool. Yeah. Thanks. Awesome. For people who want to learn more about you and FirstMark, how would they do that?
So I am active on Twitter at Matt Turck, MATTTURCK, so 3 T's, Matt Turck. I blog at mattturck.com, so that Mad Landscape we were talking about, that's on my blog at mattturck.com. And then FirstMark is firstmarkcap.com. You can find a lot of the Data Driven NYC talks, actually the whole library of Data Driven talks on YouTube. So if you just search for Data Driven NYC, you'll get to the channel, and I would encourage everyone to subscribe, because if there's one thing we're proud of, it's the overall quality of the speakers.
You have probably the most stacked speaker lineup I've seen. It's insane.
Thank you. Yeah, no, it's you know, it's been absolutely amazing to be able to have those conversations with those folks. So I would you know, highly recommend checking it out and subscribing. I think that's about it. Like, hopefully Data Driven NYC will go back in person at some point. So we've actually very much enjoyed being on Zoom, precisely because anybody from in the US, and as it turns out, the rest of the world can attend the events live, which is fun. But like, hopefully we'll get back in person as well, because you know, in hybrid mode, where we'll have some Zoom events and some in-person events, because that was a really special thing, which which sort of just happened, and it was never quite planned that way. But you know, Data Driven, like pre-pandemic, we would open RSVPs on our little like meetup.com thing, which is like the, you know, the worst. I mean, it's the worst. I know.
Oh yeah,
building it, but it's the worst.
I run meetups. Right? I run a bunch of meetups too. I do not like meetup.com.
Yeah,
at all.
You know, I think you know, it was repurchased by a group in New York, and I think they're trying to turn it around into something. Is you know, I think Meetup has a like amazing user discovery mechanism, but that was otherwise crap from a actual event sort of organization perspective. But regardless, like, we would put stuff on Meetup we'd open RSVP on Meetup at like 8:30 a.m. and by like 8:40, like the whole thing was gone. Oh, right? Wow. It was almost, which is sort of a you know, fun but kind of ridiculous for like a geeky data event, right? Like, it was almost like a rock concert. Like, the whole thing would be gone, and there'd be like, you know, 300 people on the wait list, and then we could never find a room in New York that was large enough. So for many years we were at Bloomberg, which had about 270 seats. And most recently we were at Moody's, which had I think about 300 seats. And somewhere in the middle we were at AXA, which had 500 seats. And each time, like, we would you know, fill up the room, and we can never fit. We never found a room that was big enough to like fit everyone. So I mean, not to make it sound anything more than what it is, but it felt like a very vibrant, special community, and being in person together, you know, in a way that hopefully was very sort of egalitarian, where it's like we're all in together as a community event that's free, that's open to all, where we have some of the best speakers so that we can all learn together, and being in a room that was very special. And obviously there were like a lot of the type of like serendipitous things that happen when people are together in a room. So there were, tons of people that found their next job. There were companies that got funded, and there were like even companies that were formed where, it was like people meeting at the event, like over, a beer, which was intensely rewarding for me as an organizer of that community. Cool. So yeah, so very much hope that in addition to continuing doing Zooms, we'll be able to go back in person, because that was special.
That'd be cool. Well, I'll fly out for one. So
yes, please.
Yeah, I promise I will. Yeah, because I went to the MLApps happy hour in San Francisco a couple months ago.
Okay.
And that was really cool. Just people hadn't seen each other for 2 years.
Yeah.
Beer, right?
Yeah.
So
I miss it. Like this whole like Omicron thing was like a bummer, because like
it was.
Yeah, I was like, we were talking actually about like trying to find a venue, and then like that happened, and then all the venues said, "Oh, well, we closed." So anyway, hopefully sometime in 2022, and everyone welcome.
Awesome, Matt. Thanks a lot.
Cool, Joe. Thank you so much. Really enjoyed it. Really appreciate it. Thank you so much for having me.
Of course, anytime, man. Sip.